Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilly and Ian Dyer. Each week we look forward to sharing our viewpoints with you, our readers, and giving you insight into what's on our radar. Today's outlook is for the week of January 28th, 2019. I'll begin with sharing with you what I'm watching, and then we'll hear from Ian and Paul. It's shaping up to be an eventful week for the markets. U.S. and China trade talks are at a crucial point. Chinese trade officials arrive in Washington, D.C. this week to help lay the groundwork for resolving the ongoing trade dispute. Vice Premier Yeo He will meet U.S. Trade Representative Robert Lighthizer and Stephen Mnuchin over Wednesday, January 30th, and Thursday, January 31st. The U.S. has given China until March 2nd to make progress on the trade issues, and China, I can say, is incentivized to do just that because per Bloomberg data, these talks are on the heels of China's industrial profits falling 1.9% last month after a 1.8% decline in November. We'll also hear from Federal Reserve Chairman Jerome Powell on Wednesday. He will hold a 2:30 p.m. press conference following a two-day meeting of the Federal Open Markets Committee, or FOMC. His speech will give us insights into whether Fed officials still expect to raise rates 2 times this year. The FOMC rate decision, which will be released at 2 p.m. on Wednesday, is forecast to remain unchanged at 2.5%. We can expect to see the January's jobs report released on Friday, February 1st at 8:30 a.m. Currently, the market is expecting a change in non-farm payrolls of 165,000 versus a very robust 312,000 reported in December. And the unemployment rate is expected to remain unchanged at 3.9%. Now, with the partial government shutdown over, we can expect to see furloughed government workers counted as employed because they will receive their back pay. Uncertainty remains as to how government contract workers who will receive no pay for the time missed and how that will affect both readings since they fall under the category of private sector workers. And also on Friday, the Michigan Consumer Sentiment Index monthly survey of U.S. consumer confidence levels conducted by the University of Michigan will post the final sentiment print for January. This number is based on telephone surveys that gather information on consumer outlooks concerning the overall U.S. economy, and it's intended to gauge the mood of American consumers with respect to their economic well-being and expectations. The number is projected to remain unchanged at 90.7, and the University of Michigan stated that the last time the sentiment index was consistently above 90 was between 1997 and 2000, when it recorded an average of 105.3. It's a big week for corporate earnings. Companies like 3M and Apple report on Tuesday, Microsoft on Wednesday, and Amazon on Thursday. And finally, we'll hear from Exxon and Merck. They'll report earnings on Friday. On the technological disruption front, I couldn't let this week's talk pass without mentioning some interesting developments on the automotive front. According to carscoops.com, Chinese upstart Lynk & Co. It's a car company that didn't exist 3 years ago. Well, it claims that it has become the world's fastest growing brand after reporting it sold just over 120,000 cars in China last year. Lynk & Co. is a global automotive brand formed as a joint venture between Geely Auto Group and Volvo Car Group. Lynk & Co. dares to disrupt the established automotive industry with a lineup that meets the desires of a new generation of globally connected consumers. Lynk & Co. introduces a new business model based on personalized services, sharing potentials, the first dedicated app store for cars, and an open API, which is just short for Application Programming Interface, which is a software intermediary between two applications that allows them to talk to each other. This is all included with their new car brand. So Lynk & Co. currently produces and sells the 01 SUV, the 02 crossover, Future vehicles like the 03 sedan, the 04 hatchback, and the 01 SUV coupe, they're all forthcoming. And finally, this new car company is planning an important global expansion. So they will soon launch cars in Europe in 2020, in Amsterdam, Berlin, Brussels, Stockholm, and London and Barcelona, those huge cities. And then the company will enter the U.S. market. So lastly, our Disruptification Index has made great gains so far this year. As of Friday's January 25th close, it's up 17% versus 6% on the Dow and the S&P 500. And this is a beat of nearly 3 to 1 year to date. So that's it for me. Ian, what are you watching?
Thanks, Amber. So first, I want to talk a little bit about the VIX, or Volatility Index. And for anybody who doesn't know exactly what this is, it's an index that measures the amount of kind of volatility or fear that's in the market right now. So exactly what it does is measures the amount of premium on put options for the S&P 500. And of course, when people buy put options, they expect a stock to go down. So when the premium on these options is high, it means a lot of people are piling into them at once and even willing to pay more than what they normally would to buy the put options. And so when this index is higher, it means that there's more fear in the market. And as of Friday's close, this index was trading at 17.42, which is down about 52% from the high that it made around 36 on Christmas Eve when the market hit its low point from this correction. So that means that there's a lot less fear in the market right now, and people are refraining from hedging their portfolios as much, and instead they're putting that money back into stocks, as we've seen by the huge rally that we've seen in the past month or so. I also want to talk about earnings a little bit. As Amber said, there's some pretty important companies that are reporting this week. A few of them are Microsoft, Amazon, Facebook, and even Tesla and Caterpillar are reporting. And Caterpillar is one that I like to watch personally to get a gauge on the economy because they are one of the, at the forefront of production all over the world. They do construction projects everywhere, especially in the China and U.S., which are the two biggest economies in the world. So usually their earnings calls are filled with really good information about how the global economy is moving along. So some things that I've noticed so far in this quarter's earnings reports is that even though analysts have lowered their expectations for companies' earnings growth, that was really due to the fear in the market that we saw during the correction. And even though it's still early right now, 71% of companies have reported higher than expected earnings, and even the companies that haven't, we've seen buying in those stocks. So, for example, the companies that have not reported earnings as strong as expected have gone up 1.5% in the 2 days following that earnings report. So that could suggest that people are starting to change their minds in the market. The earnings, along with the movement that we're seeing in the VIX, people are turning bullish and expecting improvement in the economy. And we've also seen this based on the amount that foreign stocks are rallying. So, for example, China is up about 6%, Japan is up about 8%, and Europe is about 7 to 8% up in the past 3 to 4 weeks. And even States, the S&P 500 is up about 6% this year as of Friday's close. So it's looking really good for stock markets all over the world right now. Companies are reporting strong earnings, and this is something that we expect to continue here in the United States as companies continue to report. And one thing that I'd like to mention just in closing is that we have a service called Rapid Profit Trader that is launching a very exciting trade this week. We're really excited about this. We've traded this particular we've traded options on this particular stock 2 times in the past that have generated huge returns, and we're very excited to get this trade going now that so many stocks are on the move up. So that's all that I have today. And Paul?
Thanks, Ian. So Ian mentioned Caterpillar, and I just want to provide some more comments on that. So Caterpillar actually said that it is expecting 2019 to be a modest growth year. And the reason why that's important is that when you look at what happened over the last 3 months, modest growth is actually positive news because it's clear that any number of people, large investors, were thinking that there was going to be a global recession somewhere this year. So for Caterpillar to come out and say that they are going to see modest growth because of the nature of their business, that's a great sign. It's telling you that there is no global recession, there is no crash, there is really nothing of any great significance that's happening. It is completely normal for economies of the world to see slight slowdowns and slight spurts in growth, and that's really pretty much expected. And for sure, companies are affected. However, when you saw the size of the moves and the speed at which it happened last year, it would tell you that it's clear that that was a complete overreaction to what really is fairly normal conditions. So that's one thing. And just like Ian, over the weekend, I saw all the earnings numbers. And once again, when we go and listen to what companies are saying, they are telling us, generally speaking, that their businesses are solid. In other words, there's customer demand for what they are selling, and they continue to make more, which is a good sign. So the rest of this, for the rest of my comments, I want to go back to some themes that Amber brought up, and particularly about the car company in China. And to me, that's very representative of what I believe is really the dominant theme of investing today in the stock market, which is something I talked about last week, which is the new versus the old. Invest in the old, and you get modest returns and potentially losses. And I keep bringing up Sears as an example, or companies that are going bankrupt. Invest in the new, and you do expose yourself to volatility. However, you can be almost certain that you eliminate the greatest risk of all, which is that your company goes bankrupt. And so today I want to put up this chart that shows you the music business. Now, those of you who are in the music business or have been following it would have known that this is a business that has been in deep decline for nearly 20 years because of the fact that the sales of CDs have been slowing. And this is a great example. So if you're in the business of selling CDs, you're in a depression. However, if you're in the business of streaming, you're in a boom, new versus old. And you can see that in the chart, which is that physical CDs sales are in decline, streaming is going up. And you can take this theme and extrapolate that out to so many different parts of our economy. And I'm going to just quickly go into one more segment of our economy that few people think about when they think about new versus old, and that's the financial sector. This is a sector that has really done very little in terms of innovation, very little really to make people's lives easier. And I believe the financial sector, meaning banks and money managers, all these companies that have really made a very good living from pretty much doing the same thing for something like 50, 75, maybe even 100 years, they're about to be disruptified. And you can see it by this chart showing you that between 2010 and 2017, $100 billion has been going into private investments. In other words, innovative companies that are looking to do things better, different, cheaper, give you more choices, make you more convenient, that have the banks, all of these old world financial companies in their target scope. And that $100 billion, you can be sure, is going to absolutely disruptify these big banks that have been out there. And so it's a place where across our services we're going to be looking to make investments because we can see that some of these companies are going to be huge. And just like with Amazon and some of the others, this is going to be another sector where there's only going to be a few winners. There's going to be 3 or 4 winners, and they are going to be huge. So the theme versus old is something that we focus on a lot at Bold Profits Daily and at Bold Profits are in general across our services. And the last thing I'll say is that when you actually look at the valuations of companies in the private sector versus what you can buy in the stock market, they're cheaper in the stock market. And this was one of the reasons why our disruptification index, I believe, is really outperforming, which is that people can go to like, well, where can I buy innovation? Where can I buy new world companies? And they're cheaper in the stock market. And so it's an absolutely great time to buy into these companies, which is why I'm incredibly optimistic. Even though our companies are volatile, I still believe they're going to make it worthwhile for you to be invested in it. So that's what I have. I'm going to hand you back to Amber.
Thank you so much, Paul. Great insights as always. And thank you, Ian. We always enjoy hearing from you. And most importantly, thank you for our listeners. Thank you for tuning in this week. And we hope that you have a wonderful day. And we shall talk to you next week. Until then, take care.